Most beginners think they need the perfect timing to start investing. They're terrified of buying at the absolute peak. But in real life, my own investing journey was far from perfect. Over the last 5 years, I've been buying the same two ETFs across 3 different accounts at 3 completely different starting points, through crashes, all-time highs, and everything in between. So today, I'm showing you the real numbers and the real returns. I will take you through all 3 accounts one by one, so you can see exactly how these 2 ETFs performed when starting at 3 different market stages. And hopefully, it gives you a clearer way to think about your own investing journey. Now, quickly before we start, this isn't financial advice, and these aren't the only investment I own, but these are the 2 ETFs I've trusted the longest and the 2 I honestly don't plan to sell anytime soon. Hi, I'm Cici. I'm a chartered accountant with a master's degree in finance. Let's dive in. Right, let me quickly explain what these 2 ETFs actually are. The first one is Vanguard S&P 500 ETF, VUSA and VUAG. This ETF tracks the S&P 500 index, which basically represents the 500 largest companies in the US, like Nvidia, Apple, Microsoft, and Amazon. I originally started with VUSA, which is the income version. That means the dividends get paid out to you quarterly as cash. But later, when VUAG became available on the Vanguard platform, I started to invest in VUAG instead. VUAG tracks the same S&P 500 index, but it's the accumulating version. So instead of paying dividends out as cash, the dividends are automatically reinvested back into the fund to buy more shares. And personally, I prefer that, because I want the dividends to stay invested and compound without me manually reinvesting them. The second one is Vanguard FTSE All Worlds ETF, VWRL and VWRP. This tracks the FTSE All Worlds Index, which gives exposure to around 3,700 companies across the world, developed markets, emerging markets, all in one fund. I started with VWRL, the income version. Then later, when the accumulating version, VWRP, became available, I switched to that instead, for the same reason. So for me, VUAG and VUSA gives me exposure to the biggest US companies, and the VWRL and VWRP spreads my money across the world. One focused, one global, simple enough to hold for years without overthinking it. Let's start with the first account, my Vanguard account. I started investing both VUSA and VWRL here in February 2021. I set up a direct debit and made monthly contributions all the way until October 2024. At the beginning, markets were doing well. Coming out of the pandemic, everything felt like it was going up. And then 2022 happened. Interest rates went up, inflation hit, markets dropped, and they kept dropping for most of the year. From the past performance chart, you can see that first year clearly. From May 2021 to April 2022, VWRL was down 5.46%, and the VUSA was basically flat. But I ignored the drop and kept buying every single month. The year after, both started recovering, small gains but moving in the right direction. Then from 2023 to 2024, VUSA was up over 22%, VWRL up over 17%, and in the most recent year, both were up around 31%. This is the power of buying consistently through a downturn. When your monthly contribution stays the same, lower prices mean you buy more units. So if the market later recovers, those units can make a big difference. At the time, it felt uncomfortable, but looking back, those difficult months were probably some of the most important months in this account. I kept making monthly contributions into this account until October 2024. Then the direct debit stopped. No more new money going into this account. I simply left what was already there to keep growing. Just to be clear, I didn't stop investing in these ETFs completely. I only stopped adding money to this account. The monthly investing continued in the next account, which I will show you in a moment. And here is what those two ETFs look like in my first account at the time of filming. Let's look at VUSA first. I put in a total of £14,875. At the time of recording, the closing value is £23,760. So the unrealized gain is £8,885, and on top of that, I've received £696 in dividend income along the way. So if we add those two together, the total gain is £9,584. That's a total gross return of 97.87% from February 2021 till today. Honestly, that's much better than I expected. Now, let's look at VWRL. I put in £3,704. The closing value is £5,609. So the unrealized gain is £1,904 plus £217 in dividends. So the total gain is £2,122. That is a total gross return of 93.15% over the same period. Again, better than I expected. And this is the part I really want to highlight. This account stopped receiving money after October 2024. Not a single new pound has gone in since then, but it never stopped growing. In November 2024, after I stopped contributing to my first Vanguard account, I opened a second account under my husband's name. And honestly, this was the scary one. Because by then, markets had already recovered strongly from the 2022 downturn. The S&P 500 was hitting new highs almost every month. Everywhere online, people were saying things like this: the market is too expensive. A crash must be coming. You've missed the best time to invest. And I think this is the stage where a lot of beginners get stuck, because buying when markets are already high feels scary. But we had one rule: the investing habit doesn't stop, no matter what the market looks like. So I set up a direct debit and made monthly contributions into this account from November 2024. Same two ETFs, but this time VUAG and the VWRP instead, the accumulating versions. No dividends paid out as cash, everything gets automatically reinvested. A lot of people would say we were buying at the top, so let's look at what actually happened. And here is what those two ETFs look like in this account at the time of filming. VUAG. I put in £3,252. At the time of recording, the closing value is £3,990. That's a total gain of £737, or a gross return of 30.37% over about 18 months, starting at what many people considered an overpriced market. Now for VWRP. I put in £1,683. The closing value is £2,107. That's a total gain of £424, or a gross return of 40.99%. Interestingly, VWRP actually performed slightly better than VUAG over this period. Of course, that doesn't mean global markets will always outperform the US. It's just a reminder that nobody really knows which market will lead in the short term. This account also stopped receiving monthly contributions after October 2025, and just like the first account, it's still growing quietly in the background. So this second account taught me something important. Buying at what felt like the top didn't mean buying at the wrong time. We just need to give the investment enough time to work. Now, let's move to the third account. This is my trading 212 account. I started this account in November 2025, so at the time of filming, it's only been around 6 months, and I've been making monthly contributions ever since I opened it. Because this account is still very new, there is no huge return here yet. I'm still building it in real time. But for the purpose of the video, I'm going to show you the actual returns for the same two ETFs, VUAG and VWRP. So let's look at VUAG first. At the time of filming, the total value is £2,382, and it's up by £223. That's a return of 10.36% so far. Now, for VWRP. The total value is £1,174, and it's up by £96. That's a return of 8.9%. Now, compared to the first two accounts, these returns might not look very impressive, but honestly, I think that's exactly the point, because this is what investing usually looks like in the beginning, slow and quiet. I'm sharing this third account with you to demonstrate consistency, because after 5 years, across different platforms, different market conditions, and different stages of life, I'm still doing the exactly same thing. Same ETFs, same monthly investing habit, just a different platform and a different stage of the journey. Let me put all three accounts side by side. Account A started in 2021, so it has been invested for nearly 5 years. VUSA is up 97.87% and the VWRL is up 93.15%. Account B started near market highs in late 2024, so it has been invested for about 18 months. VUAG is up 30.37% and VWRP is up 40.99%. Account C is just around 6 months old. VUAG is up 10.36% and the VWRP is up 8.9%. And the pattern is pretty clear. The longer the money stays invested, the more time it has to grow. Not every period will look like this, of course, but time in the market really does matter. Individually, each account looks incomplete, but put them on the same timeline. From February 2021 to today, every single month there has been money going into these two ETFs somewhere. Not a single month missed for over 5 years. Compounding didn't care which account we used. It didn't care whether markets were high or low. It only cared that we stayed invested. And I think that's something many beginners underestimate. After 5 years, I honestly think consistency matters far more than perfection. And for anyone wondering why I split things across different accounts and platforms, honestly, it's mainly for risk management. In the UK, FSCS protection is generally up to £85,000 per person per institution. So as the portfolio grew over time, splitting across platforms simply gave me more peace of mind. If this video gave you a bit more confidence to start investing, feel free to subscribe and then let me know in the comments what's been the hardest part of investing for you. Thanks for watching, and I will see you in the next one.